Hello, everyone. This is going to be a recording of our discussion on fair value from March 26th, as I forgot to start the Zoom session recording. So this will be follow up and record the things that we went over during our class for those who are not able to be there. So we're going to talk about fair value and present value. And just a little background, many assets are listed on balance sheets at their fair value. If you recall back when we talked about measurement values early in the semester, as part of our general principles of accounting, GAAP allows for fair value and requires fair value for investments and for several other areas, and allows fair value on almost everything except for property, plant, and equipment. But if you choose it for assets, you also have to choose it for liabilities. You can't pick or choose if you're going to do all of them. That is the rule. Most companies do not choose to do it that extensively, but there are a few that do. But if this has become that important, then we need U.S. GAAP guidance on how to determine fair value rather than just using guesstimates and that sort of thing. So this is GAP's answer to how you should calculate or determine fair value. 3 levels. Input level 1, 2, and 3. So, level 1 inputs, if you're to determine the fair value of something that is traded in an active market, on the stock exchange, a share of IBM stock, for example, we can easily observe the price of that share of stock. It can be found on lots of websites. Okay, there are lots of buyers, lots of sellers, and so the value of that is listed, and somebody else could come along and look at it and verify it without any trouble. So if that's available, that's what we use. If there is a market where the prices are regularly set and there's a good number of buyers and sellers so that we know that the prices are not being manipulated, then that's what we use. It's directly observable. Level 2 is a situation where we don't have a directly observable, but we can observe similar or assets with the same characteristics as what we are trying to get value, and we can see those in the marketplace, in an active market. So we may not have exactly the company's stock price, but we may have a very similar company stock price or bond price that we could utilize and then adjust to match our situation. So we still have something we can observe, and those inputs from that other company are level 1, if you will, in the sense that somebody could look at them and know what the value is, and it's verifiable. Now, there's a big drop off, you might say, to level 3. Level 1 to level 2, not too big of a difference, but level 1 to level 2 to level 3 in terms of our the verifiability and our feeling of comfort, you might say, with the numbers. Level 3 means that there are no external observable inputs, nothing that we can point to in the marketplace as far as our calculations. We're going to use entirely our own estimates to determine the value of a particular asset. Usually this requires some calculation, some estimating of what we call future cash flows. So for the most part, level 3, you're going to estimate future cash flows, and then you're going to determine what the present value of those are in order to determine your fair value. So you're only going to fall to this level if you can't find level 1 or level 2. If you're at level 3, then your comfort drops off substantially and the verifiability of it. GAAP requires that you disclose in your footnotes what of your assets and how much of your assets are valued at each level so that the reader can tell how much of these assets were level 1 that I feel very comfortable with, level 2 sort of comfortable with, or level 3 where I understand and know that these are a lot of estimates and were internal estimates, no external really reference points. So if we're going to be doing some level 3 valuations to find fair value, and we're going to be estimating future values, future cash flows, and taking the present value of those, then we need to talk a little bit about how we apply the time value of money or present value. So our present value concepts, time value of money concepts that we can apply involve present value where we subtract interest out of future payments. The idea is we estimate a future or get an estimate of future payment, and some of that payment is interest. We take that out when we calculate the present value, which means the present value is always going to be less than what we're going to receive or pay in the future. Should always end up with a lower amount. And the higher that interest rate that's being subtracted out, the lower that present value is going to be. You need to discern whether it is a single sum or an annuity. Annuity is equal payments, equal time. Single sum is one time. You will treat them differently in your calculations if you do that, depending on whether they're equal payments or a single sum. We will see an example of a combination of those. Future value is used a lot in finance circles by trying to see how much something you had as lump sum now and you saving until for the future, how much that would be, you would accumulate in interest over time. So interest compounding, but we don't use it very often in accounting. So you're seldom going to apply the future value calculations. However, if payments are not equal over time, then you're going to be needing to use the net present value. Net present value does not expect there to be equal payments like the present value does. We're going to show some examples in Excel on how we would apply these concepts. So here are some examples. Let me widen up my screen a little bit or get it on the right places. So just a little bit about some tips about Excel. When you use functions, if you use the fx, you'll get a longer, a more useful dialog box than if you were to utilize just an equal sign or something like that. So we're going to do 6 examples where we use the formulas in Excel to calculate the fair value of something. So first of all is a bond. Their bond example is going to have a $100,000 face value, pays 8% annually, which is 4% every 6 months. So a typical of a bond that pays every 6 months, and it pays interest only. Let's going to do that for 10 years. That's $4,000 every 6 months, and then pay off the $100,000. So we need to know the fair value of the bond, or what it would sell for in a marketplace to do that. Okay? So first, if we pull up the FX, we did this using a 4% rate. The payment is $4,000. Notice it's 20 times because they pay it twice a year for 10 years. And we got a fair value of exactly $100,000. Then we went back and said, well, what would happen if the market rate, because it should always be the market rate we use in the rate category in the present value. Let's say that interest rates changed, or market rate changed. Instead of using 4%, it went up to 10%. So that would be 5% every 6 months. And we got a present value, or a fair value of the bond, of $87,537 or $45.38. And change any of the functions. Now, present value, this present value function can be utilized when there is a payment. This is the equal payment each time for 20 times, and $100,000 at the end. You could put this as 0, and it would calculate just the present value of this one lump sum, one-time payment. You could put 0 on this, and it would tell you just the present value of the stream of payments. So we'll do a couple of different things depending on what functions, or arguments is the term that Excel uses, you put into your function. Okay. The next example was, we're going to determine the payment on a loan. Our loan's for $45,000, interest rate 7.5% per year, 6%, 6 years of payment. Now, we could use the present value. We could do a present value. We could put in the rate we know. We could put in the number of periods we know. We could put the future value, that's the loan amount. And we could put different numbers into the future value would be 0, I'm sorry. And that we could put different payments in here until we came up with a present value that's exactly the $45,000, because that's what a bank is doing. Bank has loaned you $45,000. It's going to charge you the payments that'll be equal, the present value of which will be equal to that $45,000. That's why they're in business. They want you to pay exactly $45,000 plus interest. Remember, the present value is pulling the interest out, separating it out, and that's how we would calculate it. But that's kind of a pain to guess at different payments until you get the right amount. So we're going to use a much shorter process by using the PMT function. PMT, or payment, we're going to put the rate in. We're going to convert this to a monthly by taking the annual rate and dividing by 12. So this is like a car payment. Number of payments we're going to multiply by 12. All right, we'll start with 6. And then the loan amount is going to be the PV. So this will do that. We don't have to guess multiple times. We can just do it one time. Calculate the present value. The future value is going to be left blank. That would be for a balloon payment. If you ever heard of a loan for a balloon payment, with a balloon payment, that's go there at the end. We don't have that. So our payment, monthly payment on this, say a car loan for $45,000 would be $778.06. Now, of course, if we were actually at the car dealership and we said, well, I don't know if we can afford that, okay, then the car dealer finance guy would go back into his little cubby hole. He would change this to a 7-year loan, get you 84 payments, and say, oh, we got it under $700. He didn't lower the price of the car. He didn't lower the interest rate. He simply made it so that you're in debt for an extra year. But just illustrate how those different things change. But that's how you get to calculate the payment on a loan. The next example is an intangible asset. Let's say that we are interested in the fair value of an intangible asset. We're going to learn next week that sometimes these assets get impaired and the new value, instead of what we paid for it, will be what they are worth, their fair value. So let's say that we're in that example or situation, and we determine that the estimated future cash flows because of this intangible asset are the company's savings. We're going to save money. This is money we don't have to pay, $32,000 per year. That's going to happen for the next 8 years. And our normal rate of interest, we always have to have an interest rate, is going to be 7%. We need to know what the present value of those future cash flows are. So we're going to use the PV function again. We're going to put in our normal rate of interest, number of periods. This time we'll go ahead and just use an annual, 8 years, and $32,000 a year. So whatever the amount we save here in payment, it would have to be, if it's per month, this would have to be number of months. If this is per year, this would be number of years. And we see that this intangible asset, because of this fact that it's saving us $32,000, is worth $191,000. All right. Next example is a business. Let's say we're going to buy or sell a business that's going to be operating, and we're trying to decide whether we should invest in that, or if someone else is trying to decide what they should invest in. Maybe this is an asset as well. Well, the reason why we're buying this business is to get a particular asset. But in this case, our amounts in the future are different. 1 year is 50, one year is 65, 1 year is 82. That means we cannot use it annuity. Can't use a present value, because in the present value function, as we saw, there is only one place for the payment. It's only one number. Can't be different. So we have to pull out our other tool, and that is the net present value function, NPV. You'll notice it has fewer arguments than the others we've looked at, present value. We still need an interest rate, sometimes referred to as a cost of capital. Okay, this is 12%. And then you can just put all the values in at once by highlighting those that should be involved in this calculation, making sure that the right ones end up in here. And click on OK. And that we see that the net present value is $154,826. That is the same as if we had done the present value of year 1, present value of year 2, and the present value of year 3 individually calculated and then added up. Same amount. That's what that function did for us. Now, this next example has to do with perhaps buying or selling a particular asset. So the example I like to use is Wolf Furniture. Let's say that we went to Wolf Furniture and they're going out of business sale or whatever. And we pick out a couch for $3,000 that has the sticker price of $3,000. Right? But the deal is we don't have to pay anything now and no interest for 3 years, and then we have to pay the $3,000 at the end of 3 years. The point being, under GAAP, there's no such thing as no interest. We talked about that under revenue recognition, that interest when it's more than 1 year is significant. So, what we're saying is that if you're going to go 3 years with no interest, first of all, under GAAP, we don't believe that. We have to calculate how much this is really a sale for. Okay, so to do that, we're going to take the present value again, present value function. We're going to pick a normal rate of interest, what would normally be charged, not the 0 that we were promised by Wolf Furniture. The number of years until we have to make the pay. Yes, we don't have to make any payments, 0. But at the end of the time, we have to pay $3,000. That's a lump sum at the end. And when we calculate that, that's only $25.18, $25.19. Why is that important? Well, on Wolf Furniture side, that is how much revenue they should record. They do not have $3,000 of revenue now. They have $25.19 of revenue now. They're going to earn the other $481 in interest over time, over the next 3 years. So some of that in year 1, second of that in year 2, some of that in year 3. So the total will be still $3,000, but it'll be spread over 3 years. That's a big difference when it comes to how well they're performing and what we're communicating to shareholders. So on the revenue side, revenue recognition side for Wolf Furniture, this is how they need to worry about how much revenue they're recording. On the purchasing side, if I buy this for my business, this $25.19 is what I'm going to use to calculate depreciation. It's going to be what I record as my asset cost. So I'm going to debit asset, couch, whatever I want to call it, $25.19. I'm going to credit a liability because I'm not going to pay cash when I get this. I'm going to have a couch, but I haven't given out any cash. So I have an asset and a corresponding liability. What's going to happen to that liability? Over time, it's going to increase by the amount of interest each year. It's going to increase the liability, credit liability, debit interest expense. So over time, Wolf Furniture is recording interest revenue on this scenario, and the buyer, me, is recording interest expense. So at the end of the 3 years, my liability will have grown from $25.18 up to $3,000 by the interest calculated each year. And then I will pay it off. I will debit loan payable or liability of some sort and credit cash for $3,000. The last example is a fair value of a loan, and we're going to look at this from the side of the lender, the bank, who, remember, as we talked about it earlier, when we loaned the $50,000, we expected it to get us back 6% over 10 years, 6% per year for each of the next 10 years. And we calculated that to do that, we have to charge our customer a payment of $555. That would equal it out. The present value of these payments, $555 payments every month, are equal to the 50,000. But let's say that we were in a situation like we are kind of now, where interest rates are dropping rapidly or increasing rapidly, but we'll just use the example of dropping rapidly. And before even this payment could be made, any payments could be made on this loan, interest rates in the marketplace went from 6%, which is what we charge, to 4%. So how would we see what that would do to the fair value of the loan? Well, we know what the future payments are, right? They're $555 a month. So we just need to know the present value of those future payments. So we take our present value calculation, we take our new interest rate or new market rate, 4% divided by 12. And remember, right, as of this point, the actual interest rate that we're charging hasn't changed. So the $555 payments are intact. Okay? But to judge their value, their fair value, we have to use the market rate, which is 4% divided by 12. We take the number of periods times 12, so we get 120 payments. And we know the payment is $555, and the loan will be completely paid off at the end. There'll be zero balloon payment. And we see that that loan that we made for $50,000 is actually worth now almost $55,000. And that makes sense because the value go up because we're getting 6% when everybody else is getting only 4%. So our loan is more valuable. Now, if some of the payments have been made and you wanted to calculate the present value, you do the same thing, except you would change this number of periods to the number of periods left in the loan. So if there would have been a couple of years of payments made, you would then take, instead of 10 years times 12, it would be 8 years times 12. And then you could calculate the present value for that, and that would be the fair value of the loan. And banks often do convert everything to fair value, including their loans, using this exact process. So that is the main points that we went over in class. Hopefully this will help clear up anything. There are a couple of items to do or practice that look very much like this. You want to use Excel to do. And then the homework looks just much like the practice. There are 2 discussion postings, one about retirement, a concept that you have to, when you reach retirement, you're going to be pulling money out of a big pot of money that you hopefully have saved up. And is it going to run out? And what you're looking at is that a value of the amount you're pulling out, the present value of that. And so you need to describe it. We're not looking for even the exact calculations, but rather just describing how you would go about it. If you choose to do the calculation, that's great to illustrate how you're doing it. But you need to describe what your thinking was. This isn't about criticizing whether or not you use the right dollar amounts as much as it is the idea of how you would go about doing it. And then the other is just an update on how we're doing on our GAP project by posting some answers that we're currently working on. If you have any questions, please put them in the discussion board, and I'll get right back to you on those. In the meantime, stay well, take care of yourself, and wash your hands extra.